Most people enter XRP with the exact same question repeating in their mind again and again. Why hasn't the price moved yet? On the surface, that feels like a reasonable thing to ask. Price is visible, price is emotional, price is what people have been conditioned to focus on. But the moment that question is asked, it already exposes the deeper issue because it assumes price is the primary signal. With XRP, price has never been the primary signal. Let's begin in a place almost no one starts. When engineers design a bridge, they don't ask what it costs on day one. They don't ask whether people are excited about it. They don't ask if traffic is already heavy. They ask a completely different set of questions. How much weight can it carry? How does it respond under stress? Does it continue to function when the rest of the system is under pressure? Infrastructure is built for failure scenarios first, not for applause. XRP was engineered in exactly the same way. So if you're watching XRP and feeling irritated because price hasn't yet rewarded your patience, you're still asking the wrong question. The real question is not why hasn't it moved. The real question is, what was this system designed to handle when pressure arrives? Because infrastructure shows its value during stress, not during calm markets. Before going further, this needs to be absolutely clear. This is not financial advice. This is educational material meant to help you understand how systems are designed so you don't react emotionally to price. And if these kinds of explanations help you think more clearly instead of more anxiously, like the video, subscribe if you haven't already, and leave a comment below. I genuinely want to know, are you viewing XRP as a trader or are you viewing it as infrastructure? This is where the disconnect truly begins. Most retail investors analyze assets from the outside in. They start with charts, candles, support levels, resistance, and short-term movement. That approach isn't wrong, it's just incomplete. Institutions work in reverse. They analyze from the inside out. They ask, what problem does this solve? How does it behave under stress? Can it move value at scale? And can it still function when markets become unstable? That difference in perspective explains nearly all of the confusion surrounding XRP. XRP was never designed to behave like a speculative asset first. It was built to function as financial plumbing, the part of the system you don't think about until it stops working. Once that clicks, price stops being the main signal. Function becomes the signal. This is how institutions define value, and this part is critical. Large financial systems don't fail because prices fall. They fail because money can't move, settlement takes too long, liquidity fragments, slippage explodes, counterparty risk spikes at institutional scale. These aren't inconveniences, they're catastrophic failures. That's why institutions don't ask, what can I sell this for later? They ask, can this asset carry massive flows without breaking the system? XRP was engineered to answer that exact question. It isn't a company, it isn't equity, and it doesn't represent ownership in Ripple. It is a liquidity instrument. Liquidity instruments have a design constraint most people overlook. They must scale in value as volume increases. Because XRP has a fixed supply, it cannot support larger flows by creating more units. The only way it supports scale is by each unit representing more value. That isn't hype, and it isn't a price prediction. It's basic system design. So when someone asks why XRP is still sitting at this level instead of exploding upward, they're still thinking like a consumer staring at a price tag. The system is asking something else entirely. Can this asset support global liquidity when stress appears? That's why the build happens first, long before price reflects it. This needs to be repeated because it's the mental reset most people need. With infrastructure, certainty matters more than perfection. During moments of financial stress, currency instability, liquidity crunches, or geopolitical shocks, decision makers don't look for perfect solutions. They look for certain ones. Speed and certainty matter more than theory. That's where regulatory clarity comes in, and it's widely misunderstood. Institutions aren't waiting for a flawless global rulebook. They're asking, can we legally use this asset right now? Will it settle without friction? And does it reduce risk or add to it? XRP already answered one of the most important questions. A court ruled it is not a security. That doesn't mean every regulation is finalized, but it does mean uncertainty was removed where it mattered most. In a crisis, certainty beats perfection every time. This is why infrastructure assets don't erupt overnight. They are positioned quietly, legally, and structurally before anyone needs them. Behavior changes first, price adjusts last. Now consider something that confuses almost everyone watching from the outside: silence. When price isn't moving, headlines are quiet, and nothing looks exciting, retail assumes nothing is happening. Institutions assume the opposite. In their world, silence often means positioning. Here's the uncomfortable reality. Large financial players don't build exposure the way retail does. They don't buy on public exchanges with market orders. They don't want volatility, they don't want attention, and they definitely don't want price spikes while they're still setting up. Their objectives are controlled entry, minimal slippage, predictable settlement, and legal certainty. That type of activity doesn't show up as fireworks on a chart. Most institutional positioning happens off exchange through custodians, OTC desks, structured products, and private agreements. It happens quietly, gradually, and deliberately. If aggressive upside appeared during that process, it would be a warning sign, not a victory. It would signal instability, thin liquidity, and unpredictable execution, all things institutions avoid. This is why infrastructure assets often appear boring precisely when they are being prepared for scale. Stability is not accidental, it is required. If an asset is meant to move massive value, price behavior during the positioning phase must remain calm. Logically, if you're routing billions through a system, the last thing you want is wild price swings during integration. Retail misreads this entirely. Retail sees low volatility and assumes disinterest. Institutions see low volatility and see reliability. Same signal, completely different interpretation. This is why XRP is so often misunderstood. XRP isn't being positioned as a speculative trade. It's being positioned as a tool. Tools are judged on consistency, not excitement. No one cares if a settlement layer is thrilling. They care if it clears fast, clears legally, and clears without destroying balance sheets. Time is another critical factor. Institutions operate on timelines that don't match social media cycles. They think in quarters and years, not days and weeks. Expecting immediate validation from price is a mistake. Price is a lagging indicator in systems like this. Structure comes first, access comes second, behavior shifts third, and price responds last. This also explains why XRP's activity doesn't resemble traditional accumulation patterns. Much of the positioning happens where you can't easily see it, and even when it reaches open markets, it's absorbed slowly and intentionally without obvious signals. Quiet absorption is the objective. Noise is the enemy. The hardest truth for most people to accept is this: if you're waiting for excitement to confirm value, you're waiting for the final stage. By the time excitement arrives, positioning is finished, systems are in place, participants are committed, and the risk-reward profile has already changed. Infrastructure does not announce itself. It prepares. Nothing happening is often the wrong conclusion. What's actually happening is preparation without spectacle. When you understand that, patience stops feeling like weakness and starts feeling like alignment with how real capital moves. Stress is where the difference between speculative assets and infrastructure assets finally becomes obvious. Systems don't reveal their value when everything is calm. They reveal it when something breaks. Financial systems don't fail loudly at first. They fail quietly through friction, delays, and loss of trust. When stress hits global markets, the first casualty isn't price, it's liquidity. Money stops moving smoothly. Settlement slows, spreads widen, counterparty risk rises. Institutions don't panic because prices drop, they panic because transfers fail, capital gets trapped, and obligations can't be met on time. That's where losses accelerate. This is why liquidity instruments exist. Their job is not to shine during ideal conditions, but to function when conditions are bad. XRP was built for that role. It wasn't designed to look impressive on a chart during a bull run. It was designed to move value when currencies destabilize, markets fragment, and speed and certainty suddenly outweigh cost. During stress, institutions don't want optionality. They want certainty. They want to know that value, sent, will arrive quickly, legally, and predictably. Every extra second, intermediary, or unresolved legal question adds risk. That's why systems that seem excessive in calm markets become essential during disruption. When stress rises, volume rises. Capital moves faster and in larger size. A liquidity instrument cannot solve that by issuing more units. because that introduces instability. Instead, each unit must represent more value so large amounts can move efficiently without overwhelming the system. That isn't speculation, it's a requirement. Large systems don't want to move millions of units when they can move thousands. Efficiency at scale demands higher notional value per unit. This is how real financial infrastructure behaves. That's why price often feels disconnected from fundamentals during calm periods. The system simply hasn't been tested yet. Adoption doesn't show up as excitement, it shows up as readiness. Institutions don't wait for crises to care. They prepare beforehand, so they aren't scrambling later. By the time stress becomes visible to the public, the tools institutions rely on are already selected, integrated, and trusted. That preparation is invisible. People only notice the moment usage spikes and price reacts, not the years of quiet work that made it possible. Judging XRP solely on calm market behavior means judging it in the wrong environment. It's like judging a fire escape based on how often it's used when there's no fire. Its value is reliability when it's needed most. Price is almost always late in infrastructure stories. By the time price moves, obviously, the structure, access, legal clarity, and positioning already exist. Price doesn't lead adoption, it reflects it afterward. Retail often believes price creates value. Institutions understand price usually follows value already established elsewhere. That difference explains why retail arrives late and emotional, while institutions arrive early and prepared. The sequence matters. A system must exist, be legally usable, be integrated, be trusted under stress, and only then does behavior change at scale. After that, price has a reason to move. Skipping steps doesn't work. XRP feels frustrating because you see development, partnerships, legal progress, and infrastructure growth without immediate price reward. That's not market failure, it's correct sequencing. XRP isn't being adopted as a trade, it's being adopted as a function, and functions aren't repriced until they become unavoidable. Adoption doesn't happen on open charts, it happens behind closed doors through pilots, integrations, and enterprise agreements. Public price volatility during those phases is undesirable. Stability is a feature. That's why price can stay flat for long periods and then move rapidly when conditions change. When positioning is complete and usage rises suddenly, price must catch up all at once. It never comes out of nowhere. People just weren't watching the right signals. Understanding this changes behavior. You stop waiting for excitement and start watching structure, access, and certainty. You stop asking why price hasn't rewarded patience and start asking whether the system is closer to being unavoidable. Discipline becomes easier. Infrastructure rewards alignment, not impatience. Silence isn't stagnation, flat price isn't failure, and lack of hype isn't lack of progress. It usually means preparation is happening out of sight. Institutions wait for certainty, not excitement. Anyone promising guaranteed outcomes is lying. XRP carries risk. Timelines can extend and competition exists. But there is a difference between blind hope and informed patience. One is emotional, the other is strategic. Understanding systems instead of obsessing over price doesn't make you smarter, it makes you calmer. And calm decision-making is a powerful edge. This content is for educational purposes only, not financial advice. You are responsible for your own decisions and research. Markets involve risk. If there's one takeaway, it's this. Stop asking markets to entertain you, and start asking whether you understand the system you're watching.